The money didn't come from nowhere. It came from you. You just weren't in the room when the decision was made. That's the uncomfortable truth behind money printing, and it matters more right now than at almost any point in modern history. Because governments all over the world have been creating money at a scale that would have sounded insane 20 years ago, trillions, quietly, repeatedly, almost casually, and every time it happens, someone pays. The question is, who? Most people think they know the answer. They picture wheelbarrows of cash, hyperinflation, Zimbabwe, Weimar Germany. They imagine prices exploding
jackpot!
overnight. That's rarely how it actually works. The real cost of money printing is slower, quieter, and much more political. And by the time most people notice it, the bill has already been paid. Let's rewind. When a government says it's printing money, it usually isn't firing up literal printing presses.
Wow,
what it's doing
free
is
money.
more subtle. The
This is
government
my
spends
lucky
more than
day.
it collects in taxes.
Come to Papa.
That creates a deficit. To cover that gap, it issues debt bonds. Those bonds are bought by investors, banks, pension funds, and increasingly central banks. This is where the magic happens. A central bank like the Federal Reserve, the ECB, or the Bank of Japan creates new money digitally. With a keystroke, no gold, no savings, no prior wealth required. It uses that new money to buy government bonds. The government gets funded, interest rates stay low, markets stay calm. On the surface, everyone wins. No tax hikes, no spending cuts, no angry voters, just money. But money doesn't enter the economy evenly. It never has, and it never will. The first people to touch newly created money aren't ordinary citizens. They're financial institutions, banks, asset managers, governments themselves. They get the money before prices adjust. This matters because when new money enters the system, it increases demand. More money chasing the same goods, services, and assets. Prices don't rise all at once. They rise in sequence. Assets first. Stocks, real estate, bonds, then wages, if they rise at all, then everyday goods. So the people closest to the money spigot benefit first. They buy assets before prices rise. They refinance debt at lower rates. They borrow cheaply. Everyone else meets the money later. After prices have already moved, this isn't a conspiracy. It's mechanic. And the math is brutal. Imagine you don't own stocks. You don't own property. You mostly earn wages. When new money floods the system, asset prices rise faster than wages. Housing becomes less affordable. Markets hit record highs. Your rent goes up. Your grocery bill creeps higher. Your paycheck lags behind. Nothing explodes. Nothing collapses. But you're quietly poorer. This is the first group that pays. Wage earners without assets. Then there's the second group, savers. If you hold cash or low yield savings, money printing is a tax you never voted on. Interest rates are pushed down to make debt affordable, but low rates mean your savings earn almost nothing. Inflation doesn't need to be dramatic to do damage. At 3 or 4%, compounded over years, it erodes purchasing power relentlessly. Your money still says the same number, but it buys less. Every year, no headlines required. And here's the irony: the more responsible you are saving, avoiding debt, the more exposed you are to this quiet erosion. Debt holders, on the other hand, often benefit. Which brings us to the third group, borrowers. When governments print money, they usually do it to manage debt. High debt becomes easier to service when interest rates are low and inflation is higher than expected. Inflation reduces the real value of existing debt. You repay tomorrow with money worth less than what you borrowed yesterday. For heavily indebted governments, this is incredibly convenient. For heavily indebted households and corporations, it can be a gift. So who loses? People who lent money expecting stability, people who trusted cash, people who don't own appreciating assets. Now zoom out. Why do governments keep doing this? Because the alternative is politically painful. Raising taxes is unpopular. Cutting spending angers voters. Defaulting on debt destroys credibility. Money creation feels painless. Indirect, technocratique. Central banks can do it quietly, framed as stabilizing markets or supporting growth. And to be fair, sometimes it works. In crises, money printing can prevent total collapse. But here's the uncomfortable incentive. Once markets expect support, they behave differently. Risk increases, debt piles up, asset prices stretch. And every time the system stumbles, more money is required to keep it upright, not because it's optimal, but because It's easier than letting things reset. This is where the long-term cost shows up. Repeated money creation changes behaviour. Governments delay hard choices. Markets price in rescue. Inequality widens as assets outpace wages. The system becomes stable but fragile. Stable day to day, fragile under stress. And when inflation finally becomes visible, when it hits food, energy, rent, the story changes. Central banks are forced to react. Rates rise, liquidity tightens. Suddenly, the same people who benefited from cheap money feel pressure. Markets wobble. Debt becomes harder to roll over. Recessions appear. And the public is told this pain is necessary. Necessary to fix inflation. Inflation, that wasn't an accident. This is the final group that pays everyone through slower growth, job losses, market volatility, higher borrowing costs. The bill always arrives, just later, and usually after the benefits have already been distributed. So when someone asks, who really pays when governments print money? The honest answer is, it depends on when you touch the money and what you own when you do. If you're early, leveraged, and asset rich, you're often protected. If you're late, wage dependent, and cash heavy, you absorb the cost. Not through a single crisis, but through years of subtle drift, higher prices, lower purchasing power, fewer opportunities to catch up. This isn't about evil governments or secret cabals. It's about incentives layered on top of math. Money printing doesn't destroy economies overnight. It reshapes them quietly. And the most dangerous part, most people don't feel robbed. They just feel stuck. So here's the unresolved question. If money creation keeps solving short-term problems by shifting long-term costs, at what point does the system stop redistributing quietly and start demanding payment all at once? No alarms, no countdown, just a balance sheet that finally refuses to cooperate.